Hey guys, wanted to come to you today from up here in DC. Unfortunately, I've got to make it a quick kind of unscripted video in response to Peter Zeihan's latest take on the Silicon Valley Bank collapse and the rest of the banking crisis right now. Unfortunately, he's made a mistake that a lot of people make when talking about this banking collapse when they refer back to the Great Financial Crisis. And obviously he's a smart guy. I'm not sure if he was making this implication to get laughs and clicks, or if it's really something that he's mistaken about. But there's this persistent idea out there in the world, right, that the Great Financial Crisis was caused by normal people, right? People, I think in Zeihan's words, baristas who wanted a McMansion, when obviously this wasn't the case. Really what was happening in the Great Financial Crisis, as I alluded to in my previous video, banks cause banking crises. Normal people do not cause banking crises. In terms of the Great Recession and the financial crisis in 2007, 2008, obviously what caused this was mortgage-backed securities and these things called collateralized debt obligations. And what these things are is basically arcane instruments that package loans and collateralize them, basically split them up into smaller and smaller tranches over time. And through banking consolidation and some other persistent issues in the market, what happened in really from 2003 or so onwards was traditional mortgages became more and more difficult to get in that environment. And so what the banks started to do is, as they were able to consolidate all this stuff under one roof, right, whether it was Lehman Brothers or Goldman Sachs or wherever, they could do all of this kind of mortgage tranching and collateralization in-house and collect fees on every step of this process. And this created a market for these very valuable collateralized units of mortgages. So these banks were lending for mortgages, they were doing these mortgage-backed securities, and they were doing the underwriting on the mortgages, and they were doing all of this often on borrowed money. And so really what started to happen was they began to run out of traditional candidates for mortgages, right? And this is where the subprime mortgage thing comes into play. And this is what Peter Zeihan is mistakenly, blaming the consumer for, right? That people who shouldn't have taken out these loans did, and that we're all sort of, we all sort of paid the price for their desire to live, outside of their means. But as academics like Fligstein and Workasi have demonstrated in well-regarded research papers, what actually drove this wasn't necessarily consumer greed, although people will always obviously want to live in a nicer house if they can, or certainly move from being a renter to a homeowner. But really what was happening here was, a massive security fraud across the mortgage industry and really predatory lending. And this fraudulent predatory lending really was increased dramatically to increase profits for these large banks, right? This is where the deceptive borrowing terms and the ballooning interest payments and the ninja loans, no income, no job, no asset type loans came into play. This was all driven by banking greed more than it was driven by consumer greed, right? I mean, consumers have wanted a house, whether you have a job or assets or not, since forever, right? It stands to reason that the only thing that changed was the regulatory system in place to prevent that from happening. And people who've studied this period of time in the banking industry will point out that it's like over half of the banks that were involved in this market have actually lost cases in court where they were accused of securities fraud. So when you have over half of the banks in the sector convicted of, predatory lending and securities fraud, and you've got something like $80 billion in settlements and reparations, this is a story that Peter neglects. I'm not quite sure why, right? Where you have, $80 billion in penalties coming from these criminal banks, right? It's not the barista down the street that put us into this situation. It was the banks. And so as this bubble was built by these investment banks, you also had macroeconomic and monetary conditions changing, right? Interest rates were going up and the demand naturally is going to fall. This is where you start to get these massive decreases in home value, and this is going to create a real problem for many American families, right? The homes are now worth less than many people paid for them. They can't sell them. And these vulnerable folks who've been sort of predatorily tricked into getting these mortgages were stuck with things that they couldn't afford, right? And so when this starts to happen, the system starts to realize that these mortgages aren't worth what they were originally worth, right? And this is where the sort of the house of cards starts to crumble, and maybe a better metaphor really is the musical chairs game starts to come to a halt, right? As subprime mortgage lenders start to fail, this ripples up through the economy, and the people who've collateralized these mortgages to oblivion and back, right? They don't know even sometimes who owned these things or what they were worth, right? Because another important part of this that isn't the fault of the barista down the street is that the ratings agencies, were corrupt and had an incredible moral hazard where, they were supposed to be assigning a legitimate risk and inherent value to these things, and they, were a rubber stamp because it behooved them. It helped their bottom line to not critique these CDOs all that much, right? So we hit early 2008, the dominoes start to fall, Bear Stearns falls. At this point, the interbank system is starting to freeze up, and this is really the beginning of a systemic banking collapse, right? But it's really important to remember, and again, just as a response to Peter's video, which otherwise I thought was excellent, we can't fall back, just because time has passed, we don't want to fall back into this pattern of blaming individual, consumers for these kinds of decisions. And these are complex industries, and there's pretty arcane financial technology being applied to these things. The consumer needs to be protected by people who are experts in the field, right? Because they're just looking to buy a home. So I think sometimes it's easier for people to sit back and sit in judgment and say, people were so greedy and clueless. Shouldn't they have appreciated that they were never good enough to own a home anyway? Why would they selfishly think the American dream even applied to them? They're just a barista, right? I mean, this is sort of the solidarity-free kind of perspective that a lot of people have on this, where it's like, ultimately, are we ever going to expect people not to want to better their living situation as much as possible, right? That's not a rational expectation. And the reason I wanted to make this video just quickly in response to Peter is that I predict that you'll see a similar kind of excuse emerge as we start looking at bank failures in 2023, right? Whatever ends up happening here, whether it goes systemic, there's a lot hinging on Credit Suisse and other banks in Europe right now. But it would not surprise me if you see a similar sort of blame the plebs narrative emerge here, when really what's happening is shenanigans in boardrooms and at the top level of banks that obviously the everyday consumer, certainly retail depositor in a bank, has no control over. So anyway, I just wanted to make this quick and get it out there since it's kind of a timely thing, and I see this narrative kind of pop up from time to time. I really, as always, thank you for watching and look forward to your comments in the section below. Thanks again.